Hello and welcome. I'm Patrick Curtis, your host and chief monkey, and this is the Wall Street Oasis Podcast. Join me as I talk to some of the community's most successful and inspirational members to gain valuable insight into different career paths and life in general. Let's get to it. In this episode, member Mentor X shares his path going from one of the largest technology companies in the world and then using an MBA to pivot into the asset management industry at not one, but two top bulge bracket banks. Learn about the compensation structure and how convoluted it can be at these larger firms, to why he jumped ship several times in his career, as well as his one piece of key advice to young listeners still mapping out their career. Enjoy. Mentor X, thanks so much for joining the Wall Street Oasis podcast.
Hey, you're welcome, Patrick. It's great to be on. Thanks for having me.
Thanks. Yes, it'd be great if you could just give a short bio to the listeners.
Sure. So I live in New York. I've been born and raised in New York and spent pretty much the bulk of my career here in New York City. I started my career originally as an engineer in the tech sector. I worked for a very large tech company that I'm sure all of your listeners, visitors would know very well. After the first portion of my career at this tech company, I headed off to business school. I went to Kellogg at Northwestern. Mm-hmm. I got my MBA, and from there did the Wall Street circuit. So went through a very large financial firm that ultimately failed, unfortunately. It was like a controlled failure. They're actually still around, but they went from, an enormously impactful and very significant firm to a shadow of its former self. Mm-hmm. And as that failure occurred after the financial crisis, I moved on through another financial services firm that very well respected and very well known in the industry, and ultimately was recruited from there to a third one, which is generally regarded as the number one firm in financial services. And
so this was on the wealth management side, right? For all of these.
Yeah, right? That's right. Yep. This is on the wealth management side. Yep. Wealth management, asset management, private banking, et cetera.
Got it. Okay.
And after that, I was picked up by a client to run and manage their family office.
Great, and that's the latest gig, right? And then we'll get to that kind of at the end in terms of what you're up to now. But let's go all the way back to undergrad. So did you know you wanted to be an engineer or a technologist kind of coming right out of school? What kind of prompted you to kind of be attracted to that space?
It's really interesting. It's a great question. So, ironically, I did know. Okay, I say mm-hmm. that sort of like, a little bit with a laugh, because when I went into the tech sector, it was absolutely crystal clear to me what I wanted to do, mm-hmm. how I wanted to do it, and ultimately where I wanted to work. And I absolutely focused every bit of my being on accomplishing that. And it worked out. And I say it's funny because, like, when I went into financial services, I almost feel like where I ended up within the financial services sector was more happenstance than it was deliberate planning.
Right.
To start. I mean, it was deliberate planning later on in my career, but initially it was just more sort of like, I guess luck of the draw than the technology part of my career.
Yeah, and so in terms of when you were an undergrad, so you're taking all the engineering courses, you have like a very specific goal. Is this during the kind of .com, like right before the .com bust? Is that fair?
Yeah, that's exactly right. Yeah, I actually finished undergrad not too long before the .com sort of implosion. I had a few years of rah, as you would say.
Yeah, did you think that played into it though, or was it something even before then, before it got going? Because it was 95 to 99 is when you went to undergrad, right?
I finished just around then. So I mean, I think that probably played a part, but it's another great question because I can honestly say that I don't think that was all of it, and I'll explain.
Sure.
My father's actually a PhD mathematician who, after graduating and finishing his PhD, found that the skill set that he brought to the table was very applicable in computer sciences. This is going back like before anyone would have thought of computers. And when you had to actually code in mathematical algorithms. So, he was a coder, and as literally as a kid, I'd sit on his lap while he was hacking away code at these, IBM mainframe computers in our basement because, he was trying to build a company. And I just had so much exposure to technology. Like, as a baby, we were playing with, 5 and whatever inch floppy disks, and, we had that green screen with old clickety keyboard. And well, then it was very modern, but today it looks like a relic. So I had a tremendous amount of exposure to the tech sector because literally my entire life I was surrounded by coders and technologists and software engineers. My father was one, and he actually founded a software development company, and that's how he paid the bills. So I don't think it was just because the .com sort of hype.
Yeah. Okay, so I buy it. So you had a lot of exposure growing up. It was kind of like your father, following in your father's footsteps a little bit. So you graduate, you kind of realize your dream. Tell me what was the most surprising thing once you got to this large technology company, and what exactly was your role there? Were you specifically in the, as a coder, or tell me a little bit about that?
Yeah, no, so I followed a different path actually based on my father's advice. So I was all about going into coding as well. And it's interesting because I kind of look back and feel like he could have given me slightly better advice, honestly. But his advice to me was, hey, look, listen, coding is going to be sort of commodity, which I guess in a way he's right, but in a way it's such an incredible skill that it would have been a good idea. So he said, why don't you go the infrastructure engineer route, because that's really, really exploding now. The internet is just, the biggest thing. The actual nuts and bolts of putting the internet together, setting it up for companies, et cetera, like being in the infrastructure side of the world could be very promising. So I followed that path, and I ended up being an infrastructure engineer at the world's largest technology company at the time, and even still today, it's arguably number one or number two.
Yep.
And it was a very, very fast-paced, very exciting career. It was incredible work, and through that opportunity, I ultimately ended up moving into a role. I moved out of the engineering ranks and moved into a very cool role that they had just invented, that they sort of thought was going to be an impactful role for their business, which was to take engineers with a specific skill set and certain types of personality, et cetera, and put them on the business side within their largest Fortune 100 client companies and have those people advise the chief information office on how to invest in technologies and how to invest in infrastructure and how to invest in merger and acquisition activity to achieve certain corporate KPIs. So
was that a couple years in, or was that a couple years in when you made that transition to that?
Yeah, it was a couple years in. Yeah, I mean, and listen, it wasn't sort of like accidental. A couple years into the engineering side, I was looking around the business and I saw that, I guess it was sexy to me. It just seemed so much sexier, so much more exciting, and so much more dynamic.
Yeah.
These business guys kind of running the world and like going out to all these big companies and meeting with the CEOs. And I just thought, that would be a really cool place to be. So in every, quarterly review and every networking conversation I had, I was trying to make my way over to the business side. And then when the opportunity finally came up, it was great.
You jumped. So you did that. Tell me, you said something about the personality of the coder. So like you felt like you were different than most coders?
Yeah, I mean, I don't want to come across sounding a little bit full of myself to the audience.
No, it's fine.
I certainly, I think the world of coders, like I said, my father is one, and it's just incredible. I absolutely love that side of the business. There's a certain, there's this quote unquote stereotypical personality of, a real highly skilled, coder. You can see it in the show Silicon Valley, et cetera.
Yeah.
And I wouldn't say I was typical of that. And the business, I would say the business leaders that I dealt with at the company at the time recognized that pretty early on. So as I tried to make my way from, the engineering ranks over to the, to the business side, it kind of was a natural fit, and I had a lot of support for it.
Fair. Okay. So when do you start kind of thinking about getting an MBA?
So it's a great question. I think I was a little starry-eyed at the time. When I say starry-eyed, I mean kind of like with the whole idea of an MBA from a top school, because I saw this guy, that worked at the company. He came in after I did, and he just seemed to be on the lightning fast track. Like, he came into the company after me, but came in at a more senior position. And within, they had tracks, like you had to be in a certain role for a certain number of years before you could get promoted or move, et cetera. This guy seemed to go through like roles in 6 months. Like, he came in at a senior role. 6 months later, he was promoted to a more senior role. 6 months later, he was running the region. And like 6 months after that, he was running half the country. And I looked at that and I was like, man, what does this guy have going on?
Right.
As a good engineer, I started doing extensive amounts of analysis on all the people running the business. And what I discovered was that it just seemed like it wasn't just him. He kind of, like, the light bulb went off for me, observing his path. But every single senior business leader that I was working with at the time had come out of like a top school with an MBA from the Harvard, Kellogg, Wharton, Stanford, et cetera.
Yep.
And I was like, oh, okay, well, I don't have that. Maybe that'll help. I didn't think I was in any way being held back. I just wanted an accelerant. I wanted to sort of like light my career on fire and kind of mimic this guy's trajectory and be like, you know what? 2-3 years in role? No. I'd rather do 6 months and just start catapulting myself to the senior ranks. Yes. So I got a little starry-eyed with that idea and started, looking very seriously into leaving the company so that I can go back to business school.
Was the thought, hey, I'm going to come back and have a more of a business or leadership role in a technology firm, or were you thinking, hey, I'm going to go straight into finance? Did you know kind of as you were thinking?
I actually did. Yeah, that's another great question. I kind of did. I didn't know that I'd be where I ended up in financial services. Mm-hmm. What I knew was that for my specific combination of skills, if I added, very significant credential, an MBA from a top school, if I added that to the repertoire, if you will, I felt I had a great, impactful potential story for the venture capital sector within financial services. So yeah, I was very focused on, actually, it wasn't on going back to this company. Not that I absolutely love that company, by the way, to this day. Mm-hmm. I have so much affection for it and the people that I worked with there. But, so nothing negative. I felt that, the place I wanted to be was in venture cap, finding, seeding, and helping to grow young upstart technology companies.
But like
help bring them to market.
You didn't, at least from what I can see from your background, it wasn't like you jumped into VC or helping upstarts. It sounded like you went really more into the larger wealth management of these large bulge bracket banks for a while. Right.
You're exactly right.
Let's start. So you get out of, you're at Kellogg, you kind of start school when you're during the depths of the financial crisis and you come out, just 2009 to 2011. So you come out, it's, the economy is still not doing great. It's kind of on the mend, and you end up at a wealth management practice. Tell me about that, or what was the thought process there? Did it something where like, hey, I'm good at sales, I'm good at building a client base, or how did you go about thinking about that?
So that's a great question. So that goes back to where we started the conversation, I believe, a little bit, which is that I didn't actually intend to end up where I ended up. So you put your finger on what was probably, I would say, the energy in the financial services sector that ended up guiding me in the direction that I went. So I did. I came out of business school like right after, the absolute depths of the financial crisis, and discovered, as many people at the time did, that even graduating from one of the world's most, prestigious business schools, the opportunities you want in that sector may just not be available. And that was the case for me. In venture cap, I mean, if you look at 2011 venture cap, the industry shrunk, but I'm just pulling numbers out of the air, but I remember people talking at the time, like it just seemed like the industry shrunk by almost 85%. Like overnight, thousands of small venture cap funds and firms just literally rolled up and they were gone. And the ones that were left, there wasn't a lot of opportunity. They weren't looking to broaden their teams and increase the size of their firms, and There was no capital really to invest. So there was no opportunity there.
But why go wealth management? Why not go investment banking or management consulting?
Perfect question. So I knew I didn't want to be a management consultant. That I knew for sure, because
Okay.
I was already kind of like at a place where, thank God, like I said, my whole life I kind of feel like I didn't always see things, quite far in the distance, like some other people. But at this point in my life, I started seeing certain things, and I just knew myself. And I said, look, management consulting, it's just not for me. I don't want to be on an airplane, 3 times a week. I don't want to be living away from my apartment 4 or 5 days a week. I just don't want that racket. So I knew that was just completely not an option for me. I wasn't even entertaining conversations about that. But I knew that, venture cap was something I wanted, but didn't seem to be at all in any shape or form available. And so I did. I said, you know what? iBanking is probably a very good fit, because if I can perhaps find a role within, a team that covers the tech sector, I know these companies like the back of my hand. I actually worked for one and competed against all the other largest ones at the time. I mean, I could be very effective. So I thought that was potentially a good fit, and I started pursuing that. But again, I just wasn't having very much luck. It's not like I was getting interviews and not getting the job. I think I've always interviewed very well. I've always told people, like, if I get the interview, I have a 95% chance of getting the job. I wasn't even getting the interview. It was
Why?
really a bad time in
Oh,
financial
it's
services.
just a horrible time. Yeah, that's true. But
It,
you were
it
coming
was just
from
a
a
horrible
you're
time.
coming from a top MBA. I'm surprised you got no looks. I guess just because you didn't have the finance background on top of it.
Yeah, so I had
Yeah,
an engineering background, and
right.
so I guess it just wasn't for whoever was seeing the resumes. I wasn't even getting the call. So what was interesting was, with my resume and my profile, if you will, et cetera, making its way around Wall Street for investment banking roles, tech sector coverage, et cetera, it was picked up by a financial services firm that called me and said, hey, the basic pitch was, we typically take people from outside financial services without a financial services background. That's specifically what we look for,
Hmm.
who have very deep experience and expertise in a sector and who have a certain profile. And we then train them to do the following. And the following ended up being, sort of this like very cool potential life as a private wealth advisor. Like if you can translate the complex technology world to business people and get a message effectively across to people who are going to be looking to deploy capital and invest in the technology sector from a business perspective, they felt, and it was their sort of recipe for success in building successful advisors, they felt that they could train the financial side of things into somebody who was really good in that type of thing in the first place.
And that totally
And
makes
that's
that makes sense. I get that. I guess my question to you would be, isn't that like jumping into wealth management coming from an MBA? Like, I mean, I know a lot of people coming out of their MBA, they have a lot of debt and they need to like make money fast. Isn't like wealth management oftentimes like you're building your book of business, you're building your client base for like years before you start making any real money? Or is
Yep.
this something where this specific firm helped you kind of scale that faster somehow?
Yep. So yes, on all counts. So that's one of the reasons that, like, when the guy first called me, I
Yep.
basically hung up on him. I mean, not literally, but it's
Yeah.
almost kind of like out of a movie. I was just like, yeah, dude, no, just not for me. And I also don't want to be kind of like molesting people's, back pocket for their wallet and sizing them up. It just, the whole thing turned me off. It just
Right.
wasn't for me.
Yep.
But he was very persistent. He was very persistent. He was like, no, you should just listen, hear this out. Called me back, et cetera, kept talking. And ultimately, at the time, I'm going on already, like, venture capital is not available. iBanking is not calling me back. It's like I'm starting to get a little nervous. And I'm like, all right, the world is definitely a different place post-financial crisis. Like you said, I have these debts. I have student loans. I have bills to pay.
Hmm.
And, the more he talked, he started talking about the potential earnings. You're talking about very significant, low seven figures type earnings potential if you're successful in those roles. And listen, looking back on it today, after so long in the seat and in the industry, it's true. I mean, I work with people who are making, low seven figures, 3 to 5, sometimes $7-8 million a year, consistently, year after year after year, at a very, very consistent pace.
Hmm.
And so, like, as I started to do my research on the industry and my research on the firm that he represented and hear the story, it started to actually appeal to me. And I was like, well, it's not what I want, but hey, you don't get everything you want in life. Sometimes you sort of have to like make do with what's available given the circumstances. And it's not like the circumstances where I just wasn't qualified for A or B. Like the financial services industry was a smoldering heap of what it once was after the financial crisis. Like we're still getting over it in some ways,
Totally.
over a decade later.
Yeah.
So, to answer the part of your question about like, hey, you need to pay bills, where's the money coming from? So this firm paid an extraordinarily impressive base salary. It wasn't typical wire house firm. It wasn't like, one of the wirehouses where they pay you $35,000 a year and then, you got to hit the phones constantly and sort of like, bring in $1 every day.
Can we talk about that? Paid. Can we talk about that industry? Because like there's a lot of that in terms of these smaller asset managers. And like you said, they call them these wirehouses where they pay you either very extremely low base or no base. And a lot of it's just based on the number, the amount of assets you can bring under management. And they give you, your cut. Can you talk about the economics of that? Just to explain to the listeners what that means and typically how much you'll have to bring in and what some of these firms look like? Because I don't know it that well, to be honest.
Yeah. So I could talk your ear off about this one. So just stop me if I
fine.
Get too long.
Just like a synopsis, like a summary of like the types of firms and what to watch out for and what's a good place to be.
Yeah.
Like, it sounds like it's kind of obvious, but because yours had a high base salary, so it's kind of like they're investing in you, right? So.
Yeah, absolutely. And that's something that really appealed to me, right? I wasn't going to go anywhere that was saying, look, we'll give you $35,000 a year. I mean, I was making, multiples of that at the technology company before I even went to B school. So to me, it was almost like a joke to hear someone say that.
Right.
But yeah, so it comes in the industry, the industry's kind of split, I would say, in two sides. You have what was generally referred to as the wirehouse model. And then you have what was referred to as sort of the RIA, or if you will, not in the RIA space, but maybe in the tier one financial services firms out there, the model where they'll pay you, sort of invest in you, right? They'll pay you a relatively significant base salary while you build your book of business. And they have all different terminology for how they refer to that salary. Some refer to it as like a forgivable loan. Some refer to it as a draw that you never actually have to pay back. It's like a draw on future earnings. But the dirty secret is you never have to pay it back. So the wirehouse model, there's, I would say, far larger numbers of firms out there that work on the, hey, we'll give you a stipend effectively, 35, 45, if you're lucky, maybe $55,000 a year. And you have to bring in, X number of $100,000 accounts, like literally within weeks. And then from there up to $250,000, and then from there 500,000, and then from there $1 million. And you just really have to very aggressively ramp up how many accounts you bring in, how much money each account has in it. And based on that, you'll earn certain bonuses. And that'll get you to potentially, a half decent, respectable income. But, I don't want to sort of sound negative on it for people that are going to go that route because, it cuts both ways. My view on it, however, is that side of the business and that model generally just grinds people out. And there's a tremendous amount of burnout. It's just, within 3 to 4 years, something like 90% of the people that go into that role in that model are gone. And all of the accounts that they brought in over that time accumulate to the senior advisors that they were bringing them in for.
Yeah.
And it very much seems like that old Wall Street, movie model where young people are out there working themselves to death.
It's like Boiler Room or whatever they call that show.
Yeah, exactly. Similar to that. Like you're not slinging stock, right? Nobody does that anymore. That model's done. But you are literally hitting the phones and making 600 phone calls a day. Well, maybe not literally, but just endlessly. You practically have a phone duct taped to your hand. And, you're just so desperate to get an account in the door. And it does feel great. And like if you're young, just out of school, whatever, it's exciting, it's dynamic, and the world is your oyster, et cetera. But the reality is most people don't make it in that model. They just don't. Now, there's the other side. The other side is the firms that'll say, look, that's not what we're looking for. We'll pay you a very respectable base salary. We'll recognize that you're coming out of a top school. We'll recognize that you have talents, abilities, and skills that are, more significant than what we could probably teach a an intelligent dog to do.
So you're like
So
salaries be like 60 to 100K kind of thing, or even more as an MBA.
depends on the level. So
Yeah.
if you're coming out of B school, the salary is going to be much higher than that. In the salaried side of the model, the salaries for for recently graduated top business school candidates is closer to just under $200,000.
Oh
Like
wow, pretty
you're
high.
looking at probably I would say 140 to 170
Yep.
is probably the range.
So they're really investing in you because you have no, you're bringing in no, I think you're bringing in nothing, right, to the firm initially, right? So they're really investing in you and expecting you to stay there for a certain number of years to bring in kind of, are you expected to bring in accounts still, or is it more like, hey, we're going to use your expertise to service the existing accounts we have?
So it's a little bit of both. So
Mm-hmm.
first of all, you're 100% right. It really is. I have to say, and that's why it's a big compliment to the business. They are absolutely investing in you. If you multiply that number and the expense of supporting an employee at that level with health insurance and vacation and benefits and everything else, if you multiply that number by tens of thousands, because in many of the big firms they do that, and over the years, it's tens of thousands of people. You're talking about an incredible amount of capital that they're investing. So they do actually. They expect you at some point in the near future after you're hired to go out there and start bringing in significant relationships. But consistent with this model where they understand that they're making a long-term investment in you, they know that you're not going to be landing these, $25 million type clients the day after you get there. And so your time is going to be occupied by servicing existing relationships as well. And that's where they kind of expect you to cut your teeth, really start to understand how the relationship dynamic works in the business, what it's like to interact with clients, the types of needs, the types of profiles of the clients that they have are, the types of demands that clients make on your time and on your human capital, right? Like, they come to you with a very complex or sophisticated problem of some sort, and you have to try and figure it out with the senior advisor on the desk. You're using that individual for a skill set that they brought to the table that's far more impactful than just, dialing for dollars, so to speak.
So should I think of it as like the wirehouse oftentimes is trying to attract individual high net worth individuals versus the larger firms who are paying you the higher base are typically going after institutions or other types of clients, or is that not
Yeah, no.
fair?
The way it breaks down is, I would say, think of it like this. So
Mm-hmm.
there's what's sort of referred to in the industry as the mass market
Mm-hmm.
wealthy, right? Which is call it 500,000 to like $1 million in investable capital,
Yep.
and then you have the 5 million in investable capital. That's generally considered a high net worth individual.
Mm-hmm.
And then you have 10 and up, which in some firms is still what's referred to as like high net. And then you have 25 and up, which is considered ultra high net or super high net. And then from there, 25 and up, they don't continue to slice and dice the market, but you have people with 6, 7, 800, $1 billion in investable capital. Those are sort of the whales that everybody's dreaming about every day in the business. But yeah, so the wirehouses, they're typically looking, and by the way, in each one of these firms, even in the wirehouses, there are different groups. So the bulk of the activity is happening in the groups that are looking for the $250,000 and $500,000 type investor to, call it $1 million, $2 million, $3 million. That's where, like, if you look at, for example, like what used to be a Merrill Lynch, 16,000 advisors,
Yeah, that's who
I'd argue,
they're dialing up all those individual
yeah,
investors. Yeah.
over 85 to 95% of the people in that 16,500 advisor pool are literally just, dialing out, looking for people with a few $100,000 to invest, maybe $1 million to invest. Now, within Merrill Lynch, there was always other groups. You had these groups that were like, the private, bank type thing within Merrill Lynch, which is now part of B of A. Same thing with Morgan Stanley. You had tens of thousands of advisors, and then within that pool, there was, this top tier where it was, only the ultra high net worth, only the super wealthy. So yeah, that's sort of how that side of the business broke down.
How do you get into that ultra high net worth tier? You build a huge book of business at the lower tier, and then they say, "Wow, you're really good at this," or is it something else to get you to that top?
So there's a couple of paths, right?
Mm-hmm.
So you could look for a firm that basically only deals with the super high net worth, where a 500,000 or $1 million account it's not reality in a firm like that.
Don't bother,
Firms that generally deal with let's call it 10 to 25 million and up. Where I worked, we were looking almost exclusively for people with 25 and up. And so you can look for a firm like that, because then from day one, again, the firm's investing in you. You're not just dialing for dollars. You're actually using you're using your mind and your brain, and they're leaning on you to really help be an integrated part of a team and bring a lot of value to the table. So you can look to start your career at a firm like that.
How do people figure out where can you find a list of firms? Like, I know we have a company database on WSO, but I don't think we have it based on, I guess you could do some Google searches in terms of ultra high net worth, asset managers, or, I guess
that's exactly right.
Yeah,
that's exactly right.
Okay.
You can do that. And there are firms out there, without, mentioning any names, that sort of everybody knows only deal with the super rich. Like, they don't take small accounts. And there's, again, I don't want to in any way sound like we're denigrating a pool of capital that's smaller or larger, is greater. No judgments, zero judgments. It's just, absolute numbers. There are people with 25 and up, there are people with 10 and up, and then there are people with 10 and below. And different firms build their model to service those types of clients differently. And there's a reason that it works that way. It has nothing to do with, viewing the person as any better or any worse. It's just how the model works.
So let's go back to your story a little bit. So you kind of join out of school, you get convinced this is something for you. They're going to invest in you. So you're at least getting a nice base salary to help pay off some of your loans, and you can survive. And I assume you were in New York and pay your rent or whatnot.
Yeah, barely. Yeah.
And then, so you're there for a year and a half, you go to a bulge bracket, you're there for a couple of years, you go to another bulge bracket, you're there. Is this typical for someone to jump to a few places? I know I've heard like you can bring your book of business. What was the case for you, for your specific story?
Yeah. So that's for the listener. That's also, I would argue, a very good question. The shortest answer I can give you is no. Pre-financial crisis, it certainly was not typical. In the asset management space, in the investment management world, the name of the game is longevity. The longer you stay in a single seat at a single firm, the higher the probability that you will ultimately get into that seven-figure earnings bracket. And the reason for that is because significant investors, people with 10, 20, 30 plus $1 million to invest, or even people with, 2, 3 million or even 500,000, when they're looking for an advisor to manage their capital and invest their capital on their behalf, they're looking for a story of stability, consistency, and strength in a seat, right? So actually, it kind of works against you. Now, as many of your listeners will probably already know, or perhaps learn after they listen to something like this, you can just look around and see that advisors jump from firm to firm. There's a reason for that. After a certain point in your career, you can jump from one firm to another, or at least you used to be able to. And the reason that advisors did that is because firm A, where they're sitting, they've reached a certain point, they're making a certain amount of money. Firm B comes along and says, hey, we will pay you forward for your book of business if you can demonstrate what the revenue looks like and how much, we'd be making off of it. We'll pay you, X number of years in advance to come on over. And when a book of business is generating a few million or, $1 million, $3 million, $5 million a year in revenue, right, to the firm, just take 5, it's an easy number to multiply.
Yeah.
If a firm comes to you and says, look, we'll pay you 4 times your annual revenue to move your book of business here, you're talking about $20 million up front. And, if they structure it as a forgivable loan, your responsibility is to move the book of business. And a lot of it is sticky, doesn't always move, which is what a lot of the firms that were doing this for a while learned. But yeah, so that's why you'll see them move. Now, for me, so why did I move? Firm A, Firm B, and Firm C? Well, Firm A, as I said earlier, failed. Like they kind of were on the brink of literally receivership. So, that wasn't by choice. So I went from there to Firm 2. Firm 2 was an absolutely wonderful, fantastic place to be, but the model from a compensation perspective there was unique. The compensation model there was salary bonus. It was never based on, entirely on the amount of revenue that you generated. So in other words, you had a salary, and your bonus was based on a complex formula of whether or not you hit a certain number of metrics from a revenue generation perspective on these different buckets of investing options for clients. So it was very complex, and you couldn't really control, like, even if you had an absolutely gangbusters year, let's say you brought in, this just absolute enormous amount of capital, but that capital didn't get fully deployed in that year, or even if it got fully deployed, it didn't get deployed across the specific investments that the firm was more interested in seeing clients in. You still weren't going to be able to achieve the types of numbers that you thought or hoped that you could.
So give me a range there for that. So like, what were you seeing at your first place? I mean, I think you were getting high six, or you're getting six figures, 150, 160 base at your first firm, then ended up failing. Did you get any bonuses before you left there, or was it just all going downhill by the time?
Yeah, no, there were no, but they were very
bonuses.
Generous to us. Actually, I'll say, like, they did the right thing. They paid us out 6 months when we left, which was very nice of them. But there was no bonus on the way out.
And then, so when you get to the second place, what was it? A similar base, or was it lower or higher? What was it looking like there?
Yeah, so that was another sort of like trick of the trade at the time. They'd ask you for your W-2, and they would say, "All right, well, this is what you were earning there. This is what we'll pay you here." You didn't really achieve any bump, unfortunately.
Okay.
There was no way to increase your earnings. Everyone was just kind of doing the same thing. Now you can't do that anymore. I think in New York it's illegal. Companies can't ask people for their W-2s anymore, which is actually, I think, a good thing, because I felt it was unfair. I felt that, like, look, if you're able to negotiate a better salary for yourself on any decent basis, why should you be limited by what you were paid yesterday? Why not just pay me what the value that you think I bring is, instead of saying, hey, that's what your paycheck was yesterday, that's what it'll be tomorrow.
Got it.
But yeah, they matched it.
So they matched it. You go in, and this complex bonus structure, what did it end up actually coming out to be those couple of years you were there? So was it another 50,000, 100,000? What was it?
Yeah, no. So you could, listen, I don't want to minimize it. You could do very well, right? The complex bonus structure, et cetera. So you could, like, listen, if you were making 175 or close to 200 grand a year in base salary, you could add another, in the first year, typically not, but you could add another 100,000. And then in the second year, if you did very well, you could add another 200,000. And in the third year around now, if you're there 5, 6, 7 years, as your book of business grows and as your team grows, and as you start to really figure out how to, make sure that dollars were flowing in the direction that, the portfolio managers and chief investment office and all that felt were, the best place for those dollars to flow, senior people there that have been there a long time, that were, sort of operating very effectively, they were making, consistently, I would say, between 500 and 800,000 a year. They'd have a year here or there where they would, have just a gangbusters whatever year, and they kissed their manager's butt enough, and so the manager, whatever it was, like, they'd get like a 7-figure bonus. Okay. But typically it was like, the steady run rate was somewhere between like 4 and 7. So average it out.
That's fair. Yeah. So talk to me a little bit about, so were you getting, those first few years about 100K bonus then in those first few years, or was it something where, like, you weren't getting it into the right funds? And what were those right funds? Is it something where the firm itself earned higher fees of some sort, or what were they trying to funnel these clients' money into specifically? Why were certain places given higher bonus structures? It's just products they were trying to promote?
It's a great question, and I could talk about this one extensively too, but I'll keep it as vanilla and short as possible.
Sure.
So actually, no, again, remember, let's paint the picture. So at the time, you're still pretty close to post-financial crisis. You're coming out of a firm that basically just kind of like was in a controlled failure. Wall Street wasn't giving out bonuses. They just weren't. I was lucky to get anything, and I did, and my team did, and it's not like they were literally shutting off the spigot, because everyone would have bolted. But the bonuses were pretty small. So I think, if I remember correctly, it's going back a ways. I feel like my first bonus there was, it was under 100,000. It was somewhere like in the 60 or 80 range. So again, for relatively young person, great great income for the year. When you add it all together, it was just under $300,000, which I think a lot of people would be very, very happy with. And I was at the time. But I, again, like I kind of like I thought I was going to be earning more. I just, based on what I was doing, my activity, what I was bringing in.
Yep.
So, second year, similar story. And that's what started becoming disappointing. It was like, it just seemed like no matter how successful you are on so many metrics, if the firm just didn't want to give out more capital, they were going to find a reason not to
pay you.
So it didn't really matter.
How much revenue do you think you were bringing into the firm itself?
Say again?
How much revenue do you think you're bringing into the firm for getting that?
So another great question. It all comes down to formulaic approach. So when you bring in money, for example, let's say you bring in, let's even numbers, $1 million. Mm-hmm. When it goes on fee, let's use 1%, right? Because that's how the industry typically works. Fees are around 1%. That's going to generate X amount of revenue, right?
Yep.
Now here's the issue. When you bring in $1 million, what part of the year did you bring it in? Did you bring it in January, or did you bring it in June, or did you bring it in October? And the reason that's important is because if you brought it in on January 1st, then on December 31st, and you got it all on fee on January 2nd, then on December 31st, they look back 12 months, and that $1 million was productive for the entire year, and so that revenue is recognized in its fullest capacity for the entire period that they're measuring.
Right.
But if you brought that $1 million in June, and it's just sitting in the account, and then you didn't get it invested until, call it, November, which is possible sometimes, by the way. You got to have multiple meetings with the client. You got to structure the portfolio. You got to get them comfortable. You have to get agreements. You got to get paper signed. It could take months. Because you're dealing with large pools of capital. It's not typically $1 million. It's $10 million or $40 million. So, deploying that type of capital can take time. So, you bring it in June, it gets invested in November, most part of it, right? If it's 40 or 50 million, you get 5 million invested in, you get another 8 million invested a few months later, and you get 10 more million. So it takes time to deploy capital. It just does. It's a fact of life. So, you don't get really recognized for any of that revenue, right? So even if you brought it in on January 1st, if it took you 10 months to get it deployed, and then by the 11th month it's all in and it's all on fee, you could literally have brought in $100 million, which would have generated $1 million in revenue in your mind, right? 1%, $100 million, $1 million in revenue. If the firm was willing to give you a bonus of X on that, whatever that is, that's what you were hoping to get. But then you sit in the office with the manager, and it's like, oh, well, you did a great job. You brought in this amazing account. It was $100 million, really moves the needle, big slap on the back. All right, so you're like looking at them expectantly, like, all right, so what's the bonus going to be? And it's like, well, it didn't go on fee until this and this time, and then it didn't really generate the amount of revenue that, you would be entitled to earn this type of bonus on, and blah, blah, blah. So there were always like, all these explanations for why you weren't going to actually get the bonus that you had hoped for. Now, as far as the other question that you asked, like where the firm wanted the money to go, the answer is, unfortunately, yeah. In a lot of cases, the firm wanted the money to go into specific types of investments that, if you didn't always agree that was, where the money should be going based on your client's best interests, you didn't have to put the money there because you want to do what's best for the client. But if you didn't, again, at the end of the year, the firm would look at things in buckets and be like, well, private equity didn't get as much capital in your particular portfolio as, we were hoping, right? Let's say they wanted private equity to be on average, 20% of a client's portfolio if the client qualified from a financial perspective, and your client's portfolios were at 15% because you were a little bit more conservative. You were penalized for that financially. Like, they wouldn't literally tell you, like, oh, shame on you. They'd just be like, all right, we understand you have a view. They'd respect your view. But they'd say, look, the firm's view is different. So, you've lost a little bit of compensation. So it did act as a catalyst to get you to sort of march to the tune of the chief investment office. Now, by the way, just to give another explanation to that, it wasn't just specific investment products. It was also services. And so this is a very, very big firm, and they offered both investment, banking, credit, lending, et cetera. And so you were also measured on how much money did you lend clients, right? If you have, call it $1 billion book or a $5 billion book, the firm expected certain percentages of your total assets under management to be represented as credit, like loans on jets, loans on yachts, loans on expensive houses, loans on art, on that sort of thing. And then the firm also expected a certain amount of that capital to be deployed in other services that the firm was bringing to the table. So if if your book of business wasn't engineered, if you will, to use a phrase from the beginning of my career, very, very perfectly to look exactly like what the firm wanted, you weren't going to get your full compensation. You weren't going to get the full
what was the
compensation
delta
that
on
you
that? Like
believed you could get.
it could be a difference of like 20%, 30% in terms of, like, instead of making, 400,000 or 500,000, you'd make like it could drop as low as 350, or was it more like on the
Yeah.
margin, like,
No, that's exactly right. It could be very significant. If you thought you were going to have a $600,000 or $700,000 a year, you could end up with. And again, these are I know how
rough
gross
numbers.
this could sound to the outside world, but just talking absolute numbers, if you expected to have a $600,000 or $700,000 a year for some reason, when you're new to the game, if you will, because once you have experience in it, you can run the numbers and see what you're going to miss,
Right.
or But if you're new, you're like, you're kind of like green and you're fresh at it. You're like, I brought in all this money, I got some capital deployed, I'm expecting like this, I'm making, let's say, 180, and like last year I got another like 80, so maybe this year I'll get another 150.
Right.
No, I mean, you could end up in the same place that you were the year before, which is what happened to me. And I just walked out of that experience and I was like, man, that really kind of sucked. I worked really hard.
You just were like, screw
did
this.
everything I was supposed to. Yeah, you just feel kind of screwed.
And you said, I'm going somewhere else then. So you started looking right away, right after that second
so
bonus?
No, I didn't actually. That
Okay.
was that was blessing. Again, I don't want to alienate your audience, but I kind of saw that as kismet, honestly.
Mm-hmm.
I thought I was going to stay at this firm. Despite that, I just said, you know what, I'm going to start tweaking my book and my business and et cetera, and sort of like, I'm going to now that I understand the system. This was now year 2. Like the first year I was just coming up. The second year I was like, wow, okay, this was a real learning experience. Third year I was like, all right, this is the year I'm going to start really like getting this down. And I'm just going to end up reflecting what the firm wants to reflect in client portfolios, so that, look, the chief investment office is there. It has a function. I don't think I'm smarter than the chief investment officer.
Mm-hmm.
And I'm going to start having portfolios sort of match that model, if you will, a lot more closely.
Yep.
So that, I can earn what I hope to earn, and so that, client portfolios perform exactly the way the chief investment office wants to see them perform from a risk and volatility and return perspective. These are all good things for clients. I don't want to make it like,
Mm-hmm.
I don't make it sound like, we were just doing things just for ourselves. These were honestly, like, at the end of the day, the firm was looking to do good things for clients, and that's the model they thought would, fit in order to achieve that outcome. And so I said, okay, I'm gonna march to that tune. It's important to march to the corporate tune. You're there for a reason.
Yep.
If you don't believe in it, then don't be there. So I said I'm going to do that. And time was going on, and I went to an event. It was an industry event where I was hanging out with a friend of mine who was there with a very senior guy from this other firm.
Mm-hmm.
And we were just talking, and, we hit it off really well. We stayed in touch, and over, a very short period of time, actually, that firm had started to ramp up recruiting as well. Things were getting a little better. Right now, you're fast forward, you're in, the mid 20 teens, and, firms were starting to be a little more aggressive about hiring and
Yep.
investing and building the business. So he said, he was like, hey, by the way, look, just wanted to know if you'd ever consider moving over here. If you think some of your clients will come, if you don't think they'll come, we can have a conversation about it, et cetera. But, we generally, we're not depending on you to bring your book of business. We understand that, you may be starting from scratch, and so here's how we'll invest in you, et cetera, et cetera. But we really think that you'd be a value add here, and we think we kind of have, if you will, to use an overused term, we kind of think we have the best mousetrap in the business.
Mm-hmm.
And by mousetrap, I don't mean like just to trap clients. I mean like, the figurative
Yes.
figurative expression for, we think we have a really, really the best model in the business for clients.
Why did they say?
So,
What was the rationale behind that? The technology behind supporting you guys. The what?
Yeah, so it was everything. This firm actually sees itself, and I say it with affection. This firm sees itself as the firm with the absolute lock on the smartest, hardest working human beings in the world. They, and in a lot of ways, they really do have the smartest, hardest working people in the world there. Mm-hmm. So first and foremost, a human capital advantage they felt that they had over the firm that I was at. Mm-hmm. And they feel and believed in a lot of ways that human capital advantage led to better outcomes for clients. And so the story was twofold. Look, first and foremost, we employ the smartest, hardest working people, and we feel that as a result, we get better performance and better results for our clients. And so therefore, your clients would actually be better off here, number one. Number two, we also invest far, far more in our technology than the firm that you're at, or at least we believe. And we think that our technology is superior. And the technology being portfolio construction, portfolio management, all the stuff that goes into managing large pools of capital for high net and ultra high net worth clients. And then incidentally, we think our brand is stronger, so you'll be able to attract larger more, call it, more significant clients in your career going forward. And finally, and, arguably for a lot of people, a very important part of the story, our compensation model is all fee-based. We will pay you very well for a number of years until you get to the point that, your compensation crosses over to full only on fee.
Yep.
But ultimately, once you get fully on fee, there's no ceiling. So instead of having like this,
complex, yeah,
$500,000, $600,000, $700,000 ceiling with a pop once in a while, if you were a really good boy or girl, you can earn seven figures every year, mid seven figures, over time, consistently. There's no ceiling, and you control your business. And by the way, the firm doesn't look for you to have capital in specific buckets and in specific areas. You construct portfolios however you want, as long as it's in the best interest of the client and you're doing well by the client feels that they're being served properly and everything is above board. You run your own show. You really are the master of your own domain. So, so it was a great story.
So why leave after 3? You were there for a while. It seems like, the sky's the limit for someone like you, great at bringing in business, good talker, good at managing, I assume you're good at managing clients' money and doing a great job. Why head out? Why leave?
Yeah. So it's a great question. So twofold. First and foremost, similar to, as it kind of the whole story started, I always had my eye on, let's call it the more senior ranks in organizations. And that's sort of where I always wanted to be. I kind of wanted to be running either an organization or a significant part of it. And, how much money I could make is important and certainly a motivator and certainly something that, will catch my attention depending on the story, but it isn't everything. And so, over time, that's where, so in this environment, I was dealing with a lot of very, very wealthy people, in some cases, people with, tens of billions of dollars in accumulated wealth. And a lot of them had family offices. And in a family office, you're not part of this big, gigantic firm with all its pluses and minuses. And you get to sort of run the show if you're running the family office for this person or people. And you do get to call the shots. You do get to do sort of what you feel is best. You don't have to have everything cleared 100 different times by a dozen different people, et cetera. And so there was this thing that was sort of in the back of my mind along the way, this is an interesting space. Maybe at some point it's something I should look into. And then, if you get into the right situation in a family office environment, you could actually start to participate in investments with the family that you're working with, and there's just a lot of interesting and attractive things about it. So it's something that was sort of in the back of my mind. All right, didn't think of it for when it ended up happening.
Basically, there's a lot more autonomy, even more autonomy than what this bulge bracket could offer you, and on top of that, you have potential other deals and co-investment opportunities almost alongside the family, which provides significantly more upside, I guess, is what you're saying.
That's in summary, that's mostly right.
And is that the reason you felt like, well, it's just an exciting thing, right? It's exciting because it's more entrepreneurial, but is that the reason you feel like you eventually jumped, or is just this one specific opportunity?
It was a culmination of a lot of reasons. Okay. Being in the first firm that kind of sort of fell apart underneath me, and then going into the second firm where you slowly learn the politics, the games, the BS, the excuses, et cetera. And then going to the third firm, which is considered, masterable finance. And there again, not to sound a little negative, but you really do. You find that look, there's a culture, there's a pecking order, there's, what I refer to affectionately as a repatriation of capital to other people at the firm. Capital that arguably should have been yours, for work that you literally did and for clients you actually signed. And so that what I found was that in the industry as a whole, that theme was consistent no matter where you were. Like firm A, firm B, firm C, that story was just true no matter where you were, no matter what the model was.
Right.
And there's a culture. You don't always agree with a lot of things in the culture, and if we discuss these firms' names, people would know instinctively, like, all right, yeah, this firm has a reputation for this or for that. And again, not to denigrate anything or anyone, but listen, there are people who can sit in a seat and swallow that for 20 years, and then retire very wealthy after a long time making consistent, significant income.
Mm-hmm.
And then there are people like me who honestly, I look at it and I'm like, look, I don't like limiters on my growth. I don't like things to sort of hold me back.
Mm-hmm.
And I don't like to march to the tune of a corporate culture that sort of sees people that start in a certain seat as a source of revenue that they can continue to repatriate pieces of that revenue to other parts of the firm or other people on the floor, because that's sort of just the way it works. And if you suck it up long enough.
So it was uncapped, but it was still a big percentage of what you were bringing in was still being kind of shared with the team, even though you were a top performer.
Yeah, well, 100% of what you were bringing in was given to the team for a small period of time, and then once you crossed over a certain number, 100% of what you were generating was going to go to you, but then you find that it doesn't actually work that way, because if you're on the team, then you kind of have to continue to give the team a certain amount of that revenue because the team supported you while you were getting there, and then once you get past that point, it's like, look, the team is in place, so you have to support the team, and it's just... you continue to find that as you peel back the onion at every different layer, you find another layer where you're like, all right, I get it. You kind of got to be a good citizen. You got to be a good corporate soldier and be like, all right, fine, I get it. I understand. It's still not there. It's still not there. And that's okay. Look, I don't knock it. It really is fine. And it works. It works very well for a lot of people. I guess I just, where I was in my life and in my career, I just felt like, look, that's cool. It's good for the people who are okay with it. For me, I think I want less limitation, more autonomy, and I want to be on the other side of the table. So as that, was a growing thought in the back of my mind, I was pretty close with a couple of clients and thought, maybe one day I could work for one of these people or do something maybe a little bit more exciting than managing large pools of capital for very wealthy folks, like help them run their business. Like I had a client who had this gigantic business of doing $1 billion a year in revenue, and they were manufacturing this very cool thing, literally manufacturing, not like software, but actually making it a thing. And he used to talk to me all the time about maybe helping run his company, and you're like, wow, that's actually really cool. I'd like to make something. So, I had that thought at one point, and then it just came up one day with another client. He was like, look, my family office is grown quite a lot, and, you've been working very closely with us, and I really believe that, we have good energy, good synergy, et cetera. Would you come over and be my chief investment officer and sort of run my portfolio, run my investments, my private investments, my public market investments, et cetera, build a team, manage it, on and on and on, everything to do with, very decent-sized family, running a decent-sized family office from an investment perspective. And initially I said no, because I thought there was too much risk still. Yeah. And I didn't think I was in the seat at this firm long enough yet. But, he continued to kind of pick away at my resolve, and
he was persistent.
He
was persistent. He had I assume a high base salary or some kickers he started throwing in to try and get you to come over. Was that?
Yeah. So he offered me more money than I was making at this firm, which was significant. It wasn't an insignificant compensation structure.
Do you mind sharing what that was or around?
I'm sorry?
Do you mind sharing what that was or the range? What it was?
Yeah. He was willing to start me at $500,000 a year, and that was before bonus, and that was before any equity in things that he was going to be investing in that he said I could ride alongside him with. Okay. A significant opportunity in that respect. And also sitting in the seat, you look at a lot of these people and you realize, look, you could get to a place where if you stay at a firm like this and you continue to build your business and you continue to, you'll eventually make a certain amount of money. But then you deal with all these clients who, I mean, they've made billions of dollars or hundreds of millions, tens of millions. You look at them and you're like, well, it's interesting. It's this dynamic. It's sort of like almost like being a glorified bank teller where, you're making your $35,000 a year sitting behind the bulletproof glass and somebody comes in with a $2 million cash deposit. And you're like, wait a minute, what do you do for a living?
Mm-hmm.
This is interesting. So it's similar in that way. We were very well paid, very well compensated, very prestigious firm, very great name, and you're making a very good living. But then you deal with these people who have hundreds of millions or billions of dollars, and you're like, how do you do that? Like, if you're an ambitious person and you want to achieve more from a financial perspective in your life, you almost can't not have that question in your mind.
But couldn't you always say, hey, look, there's always going to be somebody with more money? Like, couldn't you always just look at this and say, okay, well, there's always somebody with more money. So like, that's almost a risk, I would say, of being in that business, right? If you had stayed at that bulge bracket bank, that top bank, and kept going, you almost have a sure thing, right? Versus trying to go be an entrepreneur, for example, or trying to start your own business, or helping that client with the manufacturing business, or going to run a family office. Don't you feel like there's just inherently a ton more risk there?
You are 100% correct. That's right.
But it's still just more exciting, and you only live once, right?
Yes, for some people, myself, and in this case specifically, taking that risk, I guess maybe it's sort of like in the blood, right? My father's an entrepreneur, my brother's an entrepreneur,
Mm-hmm.
my other brother's an entrepreneur, my sister's an entrepreneur. They all do different things, right?
Oh, wow.
When I say entrepreneur, it's not like the typical thing. My father was a software developer. He started his own business, his own company. So I come from an entrepreneurial upbringing.
It's in your blood.
My brother is an attorney, but you know what? He worked for a big firm for a very long time, and then just decided, you know what? I want to work for myself. Started his own firm and has done phenomenally well. Employs a very healthy number of lawyers in his practice, has an established firm for many years now. My other brother did the same exact thing. My sister's an architect, worked for an architectural firm, and then started her own. So, I don't know, maybe me and my family were just built that way.
Yep.
Like, we'll do something for a while, but then we kind of look around and say, you know what? I kind of feel like I can do this on my own, or maybe take a risk and do something a little bit more significant for myself, right?
Mm-hmm.
And maybe that's selfish. I don't know. But yes, you're right. It is a lot of risk. And by the way, you couldn't be more right, and it's important for your listeners to hear that. If you stick with it and you go the slow and steady, and you stick with the lower risk option, which is to stay in the seat, plug away, sharpen your pencil, and just keep going at it year after year after year. And by the way, I'm going to be completely frank. Suck up so much BS along the way. Get screwed out of so much income that just gets taken away from you, literally taken away. They have to hear this, because if they're going in, they're going to be disenfranchised if they don't hear someone tell them this. You will get robbed left and right over and over. But if you suck it up, and you understand that that's the hazing that the industry puts on you for the first, in some firms for the first 3 years, in some firms for the first 5 years, in some firms for the first 10 years.
Mm-hmm.
That's just the hazing. You got to figure out each firm's little formula for it. If you stick it out and you get through it and you ultimately persevere, you will steadily make an incredibly, incredibly impressive living, and you will be very comfortable. You'll be far better off financially than most people. And it is the lower risk option. It's just a question of, if you can obviously avoid all the pitfalls of regulations and all that other stuff, don't do anything wrong, never get fired, which is another trick in itself,
right.
In that industry. You'll do very well. You will. And by the way, that's what I would say, majority of people go in trying to do. Ultimately, a lot of them wash out. It's very difficult. They can't bring in the assets. They can't bring in the clients. And so, they have to move along. And others, by the way, at the firm that I was at, there's a relatively decent percentage. It's not as high as, like the other. It's not like a 95% failure rate. But, there's a large percentage of people, not who fail, who do fairly well. But because you're interacting with such incredibly financially significant clientele, there is an impressively healthy percentage of the population there that over time will leave the firm to go either be CEO of a client's company,
Mm-hmm.
CIO of a family office, which is what I left the firm to do. They go into politics in some cases to have impact on society. They go run very large nonprofits. They just do, because at a certain point, you want a new challenge. It's the type of person they hire. They hire very ambitious, very driven people. And at a certain point, some people, even if you're making or could make lots of money, they look around at life and say, you know what, life is not perpetual. I want to do something different. I want to do something that's maybe more rewarding in some cases.
Mm-hmm.
I want to do something, and rewarding is a broad term. It could be personally rewarding, charitably rewarding, financially rewarding, whatever. I just want to do something that I feel might be more rewarding. And so people, move on to do other things.
That's totally understandable. And so that's what you did. And what's next for you? So before we wrap up, what's in the cards for you now? You think you're going to be kind of running this family office, doing these deals, or do you eventually see yourself going out on your own, or what's the thought?
I do. I'm going to be going out on my own. I think that the time was right for me to leave and run this family office, because I kind of felt that I had learned everything I had to learn. And that's not to say like I knew better than anyone. It's just what I felt I needed to learn, right? I wanted to know the business. I wanted to know the industry. I learned the positive side. I learned the negative side, the good, the bad, and the ugly. And I added it all up and got to a place where I said, you know what? I think for myself, I know that at some point in the future, what's in the cards for me is I want to run my own show. And I felt that taking an opportunity, to be the chief investment officer of a healthy-sized family office was a good step in that direction. And so, I took it for all those reasons. It was, great compensation, good relationship with the client, exciting and dynamic things that we could do together. But ultimately, because I wanted to have this be a stepping stone toward stepping out on my own entirely and do something completely independent.
And do you know what that's going to look like? Is it still going to be in the wealth management side, or as an investment officer still, or with your own capital? What's the
so what I it's funny because it's kind of like returning to my roots. What I'd like to do, and this may come as a little bit of a surprise to your listeners. So what I'd like to do ultimately is move back into the venture capital space. In the role that I was in at this last very large firm and within the family office, and it's part of the reason that I chose this family office, we focused a lot actually on deploying capital into the venture space. At this last firm, it was more like in the typical Wall Street type way. We selected managers that we thought were really good for specific reasons, and we deployed capital to them. And it ended up being that I actually knew some of those managers because I was, connected to them through business school.
Right.
And so, I started getting that excitement about the technology sector and deploying capital in that sector and all that. It started just kind of coming back to me. I guess everything was sort of coming full circle. And then this family office, the guy that runs it, he has a tremendous penchant for investing in early stage technology companies. And so it was a big part of the reason that I wanted to be there. I wanted to sort of start getting my finger on flow and getting in front of a lot of young upstart companies and sharpen that skill set again. And so, the answer to your question is I think I'd like to set up my own fund focused on early stage technology companies within the fintech space specifically, given my experience and exposure there. And also, I actually do have a passion for perhaps doing good for humanity and society. And so I would like to bifurcate the focus, one half on fintech and the other half on biotech, specifically within a certain disease category. So that's what I'd like to do.
That's awesome, man. Well, it sounds like you have an exciting path ahead of you, even though you've already been through a lot.
Thanks. Yeah. Hopefully it'll be another exciting and successful chapter.
We'll have to have you back on.
That's all I can ask for.
Yeah, in a couple of years, see where you're at. But man, really thank you for taking the time. Anything else you want to share with the listeners before we call it? Anything you'd like look back at your younger self and be like, what are you doing? Don't do that.
The only thing I would say is forget money, forget the prestige of a brand name firm, forget all of these things, at the end of the day, we're all given a certain allotment of time in this world. None of us knows how much time that'll be. We don't know if it'll be 90 years, 20 years, or 40 years. We have no clue. Mm-hmm. However, we can absolutely know for certain that there's only a certain amount of time. I would say the most important thing that I've come to in my life is to recognize that with that time, you want to use it in the most impactful way. And money doesn't factor when you think of life that way. Sure, you got to pay your bills. You want to do well. You want to be busy doing things that are productive, et cetera. I'm not saying dismiss it completely. But what I am saying is think real long and hard about what you're most passionate about and why, and try to focus your efforts on occupying yourself with something that you're extremely passionate about, irrespective of what the financial side of that story is. Because if you do that, not only may you look back on your life and feel that you contributed impactfully in some way or other, meaningful way or other, but you'll have enjoyed it every step of the way. And I know that's so stereotypical, but it couldn't be more true.
Yeah, I think that's absolutely agree. I think it's great advice. I think too many people, especially on WSO, focus on the narrow path, and I gotta be on that path, or it's, and hopefully this series of interviews opens everyone's eyes that there are many different paths to success, and success comes in a lot of different forms. So hopefully your story is just another piece of that puzzle that opens people's eyes. So thank you so much for taking the time.
Not at all, Patrick. Thank you for having me. This was a pleasure.
And thanks to you, my listeners at Wall Street Oasis. If you have any suggestions whatsoever, please don't hesitate to send them my way, patrick@wallstreetoasis.com. Until next time.